Good morning, everyone, and thanks very much for joining me. Hope everyone had a good weekend. This is the first morning market review for this week. It's Monday, it's the 8th of August, and my name is Russell. I'm a Senior Market Specialist at FXCM. Email address rshaw@fxcm.com. Just going to bring up our disclaimers. So I'll start off with the high risk investment warning. I'll keep this on screen for a few moments. And just going to bring up our market commentaries disclaimer. Hey, Howard. Anna, nice to have you guys on the webinar. I had a really good weekend. Thanks very much, Rob. Hoping yours was good as well. Just want to let you guys know tomorrow's a public holiday. Yeah, so we won't have a webinar tomorrow. I'll just bring up our references: MarketScope 2.0, CNBC.com, and TradingView.com. Yeah, so please just, if you don't get the email in your inbox tomorrow, you'll get it on Wednesday. Let's just start off with the CNBC note. And the headline says, European stocks set to climb as traders assess earnings and economic data. European markets are set to advance cautiously on Monday as investors continue to monitor corporate earnings and key economic data points assessing the risks of recession. The Pan-European Stock 600 index closed Friday session down around 0.8% after an unexpectedly strong US jobs report lowered expectations for a recession and in turn increased the likelihood of the Federal Reserve tightening monetary policy more aggressively to bring down inflation. Markets in Asia Pacific were mixed overnight, with Hong Kong's tech-heavy Hang Seng Index weighing down the region. US stock futures were flat after the S&P 500 closed out a third straight positive week, with investors turning their attention to a key inflation report on Wednesday. On the data front in Europe, August's Centex Economic Sentiment Index for the Eurozone is due this morning. Corporate earnings continue to drive individual share price movement in Europe, with Siemens Energy, Porsche, and BioNTech among the companies reported before the bell on Monday. Okay, so I think let's try and set a tone. Let's just set a tone for this week, or a theme for this week, and we can monitor and see how it how market action evolves relative to kind of let's call it a benchmark case, and then you've got a, let's say, best case, worst case scenario. Does that mean a possibility of more than 0.75% increase in interest rates? I think 75 is the market expectation. It doesn't mean that there isn't a possibility of a surprise. But 75 certainly is now the expected hike in terms of September. I'll just see if I can get those probabilities for you. I think that there were. I think on Friday there was a swivel, quite a severe swivel. I'll just bring this across. Okay, it's from CME Group. So this wasn't in the references slide. So just please be aware I'm referencing CME Group. And the current rate here, Howard, you can see is 225 to 250. This is the range. So they have priced in 70% chance of a 75 basis point. So and that was a big turn. So if you go down to the 5th of August,
no, sorry, let's go a week ago. Sorry, let's go to the 1st of August because it's easier to see here. A week ago, we had 70% at 50 basis points, 29% right at 75. Come the data on Friday, and there's been a bout and a swivel, where now we're getting the base case of 75. A week ago, base case was 50. So there has been some movement on that front. I'm just trying to close that. Yeah, so that's becoming the norm. So this is not an easy environment. There's actually something we can take a look at. Let's do the DAX, and then I'll show you Fed funds futures, just something that I think is quite interesting. I didn't look at them over the weekend, so maybe my sort of what's in my mind's dated. So I'll just have to see how it's evolved. But I think there's a very interesting situation that's developing for the first quarter of 2023, which I think is worth mentioning. Let's just take a look at the DAX here, and you can see we've got this 1, 2, and then here's the 2, 3. Okay. Now the obvious question is, well, what's going to happen from here? You know, this leg over here, I think is still in motion. This leg here. The reason I say that's because we don't have a reference candle reversal, right? But just assuming kind of we near the apex of this leg here, what happens next? And the bullish case would be something like this. Okay, and this higher trough over here can, you know, it could be a one candle sort of higher trough, and then we move up. I'm not sure how this will chart, but that's the bullish picture. Of course, the bearish would be a number of ways. It could either move down like that, okay, so sort of a vicious leg down, or it could kind of have some sort of sideways consolidation before moving down as well. So those are kind of the options open to us right now, though. This leg over here that we're in the middle of certainly seems to be corrective in nature based on current peak and trough analysis. So how do I get that? Well, I just sort of put in a kind of make this a reference peak. We've all seen this before, reference peak. Then of course, here's the reference trough, which is actually giving a fair amount of support. Then there is quite a sort of confusing situation for the next, let's say we're in March. So between March and May, it gets a little confusing, but in the end, probably turns out to be some sort of pattern, maybe something like that. So you get some sort of consolidation, breaks down out of that consolidation, and then it looks like we've broken out of that consolidation. So what we can do is then put the consolidation as sort of a pseudo peak, and then the trough here. Okay, so we've got this I should put it as a LT, lower trough. And then we've got the lower peak. Okay. And what happens here is, of course, now what happens there? So I'm fairly sure we're going to get a lower peak somewhere here, but I don't know where it is. In other words, do we have some more candles to the upside, which is, of course, distinctly possible. But are we going to take out this lower peak here? I think that might be a stretch. So let's just keep an eye on current price action. Now, the reason that we probably getting quite near to an apex here is, in my estimates, of course, we're kind of near support turned resistance. Could actually argue that we're in the middle of it. And then, of course, we take a look at last week's candle. It's a very uncertain candle. Okay, it's what we call a spinning top. In other words, market participants took price up, or the bullish participants did. The bearish participants took price down. Where did we close? Pretty flat for the week. Pretty flat for the week. And now we just acknowledge, okay, so last week was an uncertain week. All right, so we've had two really good weeks. Last week an uncertain week, nevertheless with a bullish bias to it, but really the candlestick is showing a little bit of uncertainty. And that's how we ended the week. And I think now we've got to monitor how we develop in terms of the peaks and troughs. Just taking a look here, one thing that I'm struggling with, interest rates up would normally suggest equities down. We have the interest rates up, but not the equities down. Could we explain this as an interest rate change already baked in and earnings job numbers are better than expected? Perhaps. I think we're going to go into that analysis, and the way we're going to look at it, Rob, is we'll look at the movement of real rates and see if we can come up with some sort of an idea there. Let's just complete the top down of DAX. So we've got downtrend. We're in the middle of what looks like correction. We've had two really good weeks over here, third positive week, but at uncertain tinge, uncertain color coming into it. And before we had this corrective leg, we of course had very strong support over here. So that's the type of environment we're in. Let's go down to the daily here, and let's see if there is something that we can potentially put in as markers. Okay, and then of course we'll go back to Rob's interest rate question, which is actually, I think, the question. I think interest rates are effectively the driver, whether they have been fully priced in or not. That's what we've got to try and determine. All right, so just taking a look here, a potential. So this looks like a ascending wedge here. Can you guys see that? It's an ascending wedge now. So we've gone down from the weekly. We've dropped down to the daily. Okay, we've dropped down to the daily. Remember, on the weekly we had our peaks and troughs to the downside. We've run into that weekly resistance. There was that uncertain spinning top coming in last week. On the daily chart, what we've got to monitor now is this rising wedge. Okay, so the rising wedge is it's classed as a continuation pattern. If it's a continuation pattern, then it suggests the previous trend is set to continue. Now, what we'll do is we'll just see how deep this is in terms of the fib. So we're kind of approaching that 62%. Again, I wouldn't put any real merit in terms of the 62%, other than the fact it's probably a level that a lot of market participants are watching. And guess where that 62% is? It's right in the resistance area. So this resistance area to me looks formidable. Doesn't mean that we can, doesn't mean that we're definitely going down. Of course not. I don't know if we are going to break down. What I am saying is that the chart pattern suggests a breakdown if it completes. What is a completion? Well, it's just the completion means it's got to break down out of the pattern. Now, we'll keep an eye on that. The interesting point for me is when we take a look at the last two candles. Let's say the last three candles, because the last three candles made analysis actually, in my opinion, quite tough. Let's just take a look at that. All right, so there we've got a reference candle. This is now going back to Thursday. And remember, once we get that reference candle, we need three conditions to be satisfied for a reversal to take place. We've only got two of the three. We've only got two of the three. And let me change this up here. All right. And without the third, you've got nothing. Okay, without the third, you've got nothing. What's the three? Well, the first one would be you need the highest high in at least three candles. The second one is that price has to take out the reference candle's low. And then the third, and the most important, is that you actually have to close below the reference candle's low, which we don't have. So without that, we don't have the reversal locked in yet. What's the big deal about that? Well, we're talking about a reversal pattern here. Okay, we're talking about a rising wedge. And if there's going to be a breakdown out of the rising wedge, well, one would expect to see some sort of bearish reversal coming in. We don't have that yet, so we can keep an eye out for that. On the contrary, we've actually got what looks like a bullish reversal candle, which is this guy, which is Friday's. The Friday's candle gives us the lowest low in at least three candles. Thursday's is I've got a higher high. Today's so far, it's got a high high. This candle hasn't completed. Okay, but you can see that it looks like this could be the next higher trough, and then we just carry on moving up, and the wedge just dissipates. So what are we saying here? We're saying that the last three candles make for a tough analysis. It does look as if we've got this bearish continuation pattern. It does look as if the longer term trend is still down. Okay, and if that's the case, we would expect some sort of bearish reversal to come in. And the way that we can potentially monitor that is we can go down to the hourly. So let's go down to the hourly here. And what we can do is we can just throw in a few. Yeah, I'll do it again, Howard. Yeah. Okay. So what we can do here is we can just throw in a few indicators. So let's just throw in two exponential moving averages as trigger one. Okay, so just go through to your indicators over here. And put in your exponentials and just make, use the ones that you are most comfortable with. I tend to use a 5 and a 10. Let me just try and get the settings in here. All right, yeah. All right, so you can kind of measure if there is going to be any bearish development off of the daily. Right now, daily is looking pretty good. The only reason I'm saying look for the bearish development, the upper time frames do have that correction within a longer term downtrend. Now, let's throw in a stochastic as well. And I'm just going to add in a %D here. All right, and you can just keep an eye out for the breakdowns in these indicators. Right now, it looks as if we're getting some sort of bullish movement. Okay, perhaps some resistance over here. Again, we go up to the daily. This looks like a wedge. We go up to the weekly. Okay, this looks like a correction in a longer term downtrend. So we've really worked our way from the top down to the, so from the weekly, we've gone all the way down to the hourly. So whilst the hourly certainly does look bullish, if you are going to go long, just beware that the higher time frames don't seem to be bullish. In other words, this could be that rally in the downtrend. Now, let's just do a little bit more theory on this part. It's very important. Okay, just bring up Microsoft Paint. By the way, just to let you know, we are going to be doing a scalping workshop over 5 weeks. I'm busy developing that at the moment. Probably first one I think is due 22 September. But I'll give you more. I'll give you more news as we get closer. All right, now we want to understand what we've just described here is trends. Okay, now trends would fall under, we go back to Dow theory, we would have the primary trend. I'm using the weekly to try and get a primary feel. I mean, if we go even further out, we could use the monthly, but it's kind of got to work for the type of time frame that you're looking to trade. Then you've got the secondary. Okay, let me just put in number 2. Okay, secondary, which is we're looking, so the primary trend looks down, lower peaks, lower trough. Secondary looks up, but it looks corrective because the primary is down, right? That's that wedge pattern. And then the third is actually what Dow theory actually called noise. And the reason I think we called it noise, well, when Charles Dow was doing his Dow theory, clearly they didn't have the benefits of tick data. They couldn't get the tick data, but so he called it noise. But now it's sort of very short term, okay, which is now kind of hourly and below. So with that in mind, what have we looked at? We've looked at the weekly DAX, okay. And where are we currently with the weekly DAX? In the midst of this red, okay. So we've got let's put in our peaks and troughs. Here's our reference peak. Here's our reference trough. Here's our lower peak. Here's our lower trough. And now we don't know what's going on because we're in the midst of this red leg. Is this red leg going to go there and there, which is what we showed for our one scenario? Is it going to do this, which we showed for another scenario, or is it going to do this?
which was the third scenario. And the point being, well, we don't know, but what we do know is that we do have a lower peak and a lower trough. That being the case, this red leg looks corrective. Okay, that is trend number one, primary. We go now down to the secondaries, go through to the secondaries, and then we have a couple of ways that we can look at secondaries. So you can look at it in terms of a flag. You can look at it in terms of a wedge, pennant, or you can look at it, and this is our one, in terms of a wedge. And then if these are legitimate corrective moves in the longer term trend, we would expect it to break down. And then we won't go into the noise, but clearly that's where we're looking at our EMAs, and that's where we are looking at our stochastic. Incidentally, just how it asks, just go through the three conditions again. The three conditions are just it doesn't have to be a 3-candle pattern. It has to be at least a 3-candle pattern. But for this explanation, we'll just keep it to the 3. And the idea here is we want a reference candle that has got the highest high amongst the 3. Then we want the candle to its right to break below it. That would be the second condition. And then the third condition, it must close below it. Okay. On the bullish side, it would be something like this. Something like that. Okay. So those are the three conditions, which now kind of gives us perhaps a map of what may happen. Unfortunately, it's what may happen because we're talking about probabilities. All right. Now let's just look at the interest rates, because this I think, so we've looked at the technicals, fine. We've looked at the technicals. What about the interest rates? I'm going to use US interest rates here because I think that because of the global nature of the markets, because of the global problem of inflation, I think there is a fair correspondence amongst the interest rates. Okay. Yes, exactly. So the second candle, when we say the second candle, we're talking about so the second candles would be really the third candle in the pattern, but the second one after the reference. Okay, so depending on which direction you want to go, yeah. So let's just bring in, let's get rid of the stochastic. I think that's going to confuse us. Let's keep the DAX up. Let's go to the Dow. And Rob's question is fascinating. What's going on with the movements in the market and the rates? So I think a good way to look at this, Rob, let's just bring in a 10-year. And we'll also, because we're using US rates, I think we must look at, we'll take a look at DAX first, and then we'll go into US indexes. Okay, let's just bring this in below. And what we want to do here is actually make this a real rate. So let me just show you what I mean by real rate. What you're looking at here is not a real rate, it's a nominal rate. Okay, we've mentioned this before. Nominal rates, we all actually use nominal rates. When we're talking about interest, we always refer to a nominal rate because we're always factoring in inflation. So it will be the real rate plus an inflation adjustment. Okay, so that's real rates. So your question, Rob, actually not so easy to answer, because let us assume that there is some sort of adjustment taking place. Is it taking place on the real side? Is it taking place on the inflation side? Or is it taking place in both? So there is probably discounting in, but
The idea is, of course, the fact that our core PC is at 4.79. Are we still adjusting upwards for inflation, or are we now adjusting for real rates upwards? Inflation adjustment done. So it's quite difficult to tell. So what we do is we're going to make it real. Okay, we're going to make it real. So how do we do that? So we're just going to go like this. We're going to go US 10-year, and then what we're going to do is we're going to minus the break evens. Okay, and that's going to give you your real rate. Okay, so just do that. And now I think it becomes perhaps a little easier to answer your question, Rob. Again, we won't be able to answer in a sort of a perfect theoretical type of explanation, because the correlations are going to change, but I think they'll be fairly stable over time. And what we can tell by these, let's just see. Yeah, let's start from here. Okay, we're on the daily. Let's take out the EMAs here. So we're basically just looking on the top chart. On the top chart, we've got DAX. On the lower chart, we've got real rates. And I think there is some sense to it, Rob. Let's see if we can make that. So let's start off by choosing the peak of the DAX, which is here. Okay, so around about the 18th of November, the DAX peaks. It's also fairly close to the bottom of rates, right? And when we say rates, we talk about real rates. Fairly close to the bottom there, right? And then what happens is we get a so on an absolute basis, the actual relationship makes sense. As the real rates have increased, DAX has declined. That's what we would expect. Let's bring up the US 30. Okay, you'll see something similar, right? See something similar. So the rates certainly have had the impact. It should be exceptionally clear on the Nasdaq, because the Nasdaq would be the most sensitive, one would think, to the rates. Let's bring those up. Okay, and we can stick in a correlation coefficient, but before we even do that, let's go back to DAX. That's where we're doing the analysis. So let's keep it on DAX, see if we have here we go. All right, let's see if we have some key sort of turning points. Let's look at it from the DAX side, not from the rate side. Again, so we're a little bit late here. We're a little bit late here. Okay. This one's pretty much spot on. Okay. This one's pretty much spot on. Okay. And this one's a little bit late. Okay, so it reaches the turning point here. It reached the turning point there, so this one's late. And then right now, around about there. So the turning points are pretty much spot on. What does that mean for us? Okay, so it's first of all quite obvious if you take a look at the green trend lines that the markets are moving in an inverse path to rates, real rates. Of that, there's very little to argue about. What we can also say is that the deviations off of the path at sort of where they count seem to be this one's interesting. This one's interesting because there's that one's a very interesting one. Okay, because there's a deviation both to the downside. That was very interesting. What happened back in March? Maybe this has got to do with the either the war in Ukraine, perhaps with the
announcement to start moving rates. To start the quantitative tightening process. But something happens here because the just over this period here, there's a positive correlation. Okay, there's a positive correlation. Yeah. So look, at the end of the day, Anna, you're not going to get a perfect correlation. You might get a perfect correlation, but it will be very temporary. You'll never hold a perfect correlation or a perfectly inverse correlation. But by and large, the correlation does seem to be valid here, and it makes economic sense. We don't want to say there's a correlation and then we can't back up the correlation on a sensible basis. You know and this is a very important point, because technical analysts succumb to this. They'll see a relationship and they'll take it as valid when it might just be what we call spurious, accidental. For example, if there happens to be, and I'm just obviously making up something ridiculous, but if there happens to be a correlation in the markets to the direction that the wind blows, obviously it's nonsense. It's not going to hold water. But you know, if you had to kind of track a positive correlation there and read too much into that, well, you know, you don't want to do that. So you always want to make it sensible and sensible. So I think that we can understand why the DAX is coming down, and the reason is because real rates are moving up. Well, it's making demand. It's impacting on our demand. Okay. So then the idea is, well, what's going to happen at this point? I think the discussion is fairly clear. There's an inverse relationship, but what's not so clear is what's going to happen here, because this is where we've got to make our decision, right? This is where we've got to make our decision. We've got to make our decision on the right side of the chart, and the right side of a chart is not in hindsight. So what do we do? Well, what's interesting is that there already seems to be some sort of turning point in the real rates. There already seems to be some sort of turning point, and we have already seen that there have been instances of delay or lag. So this could be one of those instances. In other words, real rates are starting to move up here. They're starting to move up here. And the question is, well, why hasn't price responded? Well, the one answer to that, Rob, is, of course, it just could be a normal lag, which has been prevalent at previous sort of vertical blue, dashed vertical blues. So that's interesting. So given the fact, let's clear out our drawings. Given the fact that we have let's tie this into our analysis, and then we can assess in a week's time how accurate the analysis was, right? But we can say that, all right, we're in a downtrend on the weekly. We're in a corrective leg, it seems, okay? We go down to the daily. This is exactly just a repeat of what we did previously. We've seen this potential continuation pattern starting to chart. We did say it's problematic. The last 3 days here, very difficult to kind of get a directional bias or prejudice, you know, whichever way you want to trade. Is it going to go with you or against you? But these last 3 candles, I think, are quite difficult. It did look, if we look at last Thursdays, it did look as if we'd get that breakdown. But wait a second, that's not quite what we've got, because we didn't get the third condition. But on a fundamental basis, we have got that turning point. We have got the turning point. So if the real rate, okay, if the real rate continues this way, I would expect some sort of breakdown here because the correlation seems to support that. But sensibly, an increase in interest rates mathematically is going to impose pressure on present values. We know that. It's just that the mechanism here might be showing some sort of drag. So that's kind of what may be happening, Rob, and I think it probably is happening, again, subject to correction. So we'll have to maybe look at this in a week's time or 2 weeks' time and come back and say, was our analysis sensible? Is that the way it played out? And of course, we'll only know that in hindsight. All right, so with that all said and done, is there any further questions? Just asking, the second candle in the rule is an engulfing pattern? Yes, I think so. I think that you can call it. So there would be this would be a second candle here, wouldn't it, Howard? So this would be the engulfing candle, wouldn't it? So this would be your turning point to the upside. Can you see that? You see that, Howard? And then you've got another one here, right? How would the inflation print affect the real interest rates? I'm pondering. I'm not ignoring you, Rob. These questions are really good questions, and they're exceptionally challenging. Let me. If inflation is down, are real rates down? No, not necessarily. No. I would imagine if inflation is down, will real rates go down? Yeah, I beg your pardon, I'm reading that incorrectly. Ultimately, yes. Ultimately. So interest rates are always looking to control inflation. How do we control inflation? These are really good questions. So I am actually writing an article on monetary policy, which hopefully will get finished today. I started on Friday, and then just the live trade. So basically, you've got a spectrum of rates. Okay, so with, of course, 0%, let's just call it. And then what the Fed's got to try and do is they've got to find something called neutral. Okay, they've got to find something called neutral. There is actually a formula for neutral, but again, it's very theoretical. You've got to take the long-term growth trend of real GDP and add inflation onto that. You'll probably get to a neutral rate. Neutral means that that's where the rates are non-intrusive. The rates are non-intrusive. They're not going to be expansionary or contractionary. And then if you want to get a contractionary policy, well, then you have to go above neutral. If you want to get expansionary, you have to go below neutral. So it really depends. So the question is, if inflation is down, is real rates going to be down? Ultimately, what you want to do is you want to get, I'll make this black. Ultimately, you want to get to the black arrow. So red arrow is contractionary, green arrow expansionary. This is not naught. Sorry, this is not naught. This is neutral. Sorry, wherever neutral is. But ultimately, you want to get to in a sort of theoretical model. You want to get to the black arrow. If your inflation is coming down, then you probably will be able to bring rates closer towards your down towards your neutral. If rates are going up, you'll probably be able to bring your real rates up so that you get closer to neutral. So yeah, the real rates would be adjusted on the front end of the curve by the Federal Reserve, very much based on what inflation is doing. I hope I'm answering that question, Rob. It feels like I'm sort of wavering a bit, but just sort of direct me if I'm heading in the right direction. Ultimately, you know, what we got to make sure of is that I'll just bring up CPR, which is the core number, right? Is we've got to make sure that inflation's coming down. that's hard to argue at the moment. The reason I haven't brought up PCE is because I'll have to do it as a rate of change, but the whole idea here is it actually looks like inflation's kicked up. So I don't know, you know, if we can really argue that real rates have finished moving. We'll again have to wait and see. Besides that, again, the sort of hidden factor here, is quantitative tightening. That's the hidden factor, because quantitative tightening is also going to impact on rates. So we've kind of got two, they get related and perhaps interconnected, but they're very different mechanisms in terms of what's moving rates. You've got the short end, which is monetary policy, and then you've got quantitative tightening, which is along the curve, because you're going to have 35 billion on the back end of mortgage-backed securities, and then you're going to have 60 billion anywhere in between, probably in the belly, right? So there's a lot sort of that could influence your real rates. Very, very difficult to analyze, because the variables themselves are complex variables. So I think, you know, taking a look at this on a technical basis makes sense, because we can see how the price is moving. Does that answer your question, Rob? Just let me know. I think what we'll do is we will conclude at this point. I feel that we have touched on a fair amount, but just the key takeaways, still looks very much like a dead cat bounce. The interest rate has turned. Is the bottom trend, that noise, is that going to comply? So so we're going to have to wait and see. All right, guys, let's wrap up. Not tomorrow. I'll see you guys on Wednesday. Thanks very much, and speak to you then.